Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So since my last update, I talked about how in the month of May, basically we ended up where we started off. So it was, if you had gone to sleep at the beginning of May and woke up at the end, you'd have been like, okay, an uneventful month, but it was eventful. I mean, the markets were really volatile, and now we're in June and we're sort of seeing much of the same thing. We had about 10 days of the markets trading within a fairly narrow range, trying to figure some stuff out, and then all the media starts focusing on the Federal Reserve's raising interest rates to try to counter inflation, and oh my gosh, we're headed for a recession. So I'm going to take a second and talk about a couple of these things, but the first one I want to touch on is we're headed for a recession. So what is a recession? A recession is where you have two consecutive quarters of GDP shrinking. So, or no GDP growth. So it's shrinking. And historically, if the GDP is shrinking, then that's a bad sign, right? It typically means the economy's slowing down, and it's a bad forward-looking indicator. And as you start to see the first quarter of the economy shrinking, then you start thinking, oh my gosh, it's going to happen again. Then we're in a recession, and who knows where this is going to end. So in order to know whether what we're currently seeing means that we're going to be in a recession, you got to understand what GDP means. So our GDP in the United States is made up of consumption, investment, government spending, and the net of exports against imports and exports. And so historically, again, when we head into a recession, all things being equal, it's because consumption and inventories have fallen, and so the economy starts to shrink. Well, in today's world, the reason that we're seeing the possibility of a recession is not because consumption and personal spending. I'm going to show you a chart here right now that shows personal spending is not falling. So what is falling? And that answer is government spending. So here's another chart that shows government spending, over the last 10 years or so, but specifically I want to focus your attention on since the pandemic. You see that there was a huge spike in government spending during the pandemic. So what does anybody actually think is going to happen when the government can't continue to spend all this money they've borrowed from the future? And when you look at the GDP formula and you say, well, gee, if government spending falls substantially, then GDP can shrink. But is that really a bad thing? If personal spending and investment are not shrinking at the rate that government spending is shrinking. And that's one of the reasons why, even if we do fall into a technical recession, as long as the media doesn't, push this huge amount of negativity and convince people to, oh my gosh, we're in a recession, maybe we should stop spending money because we got to hoard our cash. Well, all right. Well, then that exacerbates a recession, because now, in addition to government spending falling, as it should, if consumption or personal spending falls, now we actually find ourselves with a meaningful recession. So all the doom and gloomers that are talking about, a recession that's going to happen, in reality, I think if the government didn't spend the trillions and trillions of dollars that it spent over the last 2 years, we'd have already had a recession, because there would have been no government. Spending did fall during the pandemic, and so we'd have been in a recession. So I'm not as negative about the concept of we might be in a recession coming up here soon as the media seems to be, because again, in my opinion, it's primarily due to the fact that government spending has to fall, should fall, because we've just been spending just way too much borrowed money over the last 2 years. Now, not commenting on whether we should have done it or shouldn't have done it. the government did what it did, right? During the end of the Trump administration, they approved a bunch of spending. During the beginning of the Biden administration, they approved even more spending. If there's one thing that the government seems to be able to agree on, it's spending. So whether it's had the desired effect or not, it is just what it is. So if a recession comes, unless we add to it, unless we get negative, which there's no reason to expect that we are going to, then it's just a thing. It's not evidence of a trajectory. It's really evidence of we spent way more government money than we ever have in a 2-year period of time, and so GDP has no choice but to shrink. Now, there is one thing that could keep us from actually experiencing a technical recession, and that's with the 11 million plus jobs that are open in the United States. If more and more people get back to work, then consumption can actually outstrip the reduction in government spending. And it's possible, I'm not saying likely, but I think it's possible that we even technically avoid a recession. So I guess what I'm trying to say is that while the market volatility, the markets are certainly reacting to the fears of a recession, they're also reacting to the rise in interest rates from the Federal Reserve, and the Federal Reserve is taking steps and is expected to take additional steps that it really has never taken to try to slow down inflation. And me personally, as I look at what the root cause of inflation is, the Federal Reserve's actions are not going to slow down inflation. Our primary inflationary indicators right now show that we have way too many dollars in the economy because of all the money that the government borrowed and the Fed has been giving to the banks, chasing not enough goods and services because our industrial capacity is still trying to climb out of the whole pandemic shutdown thing. Our supply chain is challenged, and we've got a ways to go to get back to the point where our supply chain can actually meet the demand caused by all the dollars that the government has stuffed into the economy. So, the Federal Reserve raising interest rates, all that's doing is making it harder for people to afford houses, but it's not going to change the fact that oil prices have gone through the roof, and those increase in oil prices are just trickling through the entire economy as it costs even more money to truck goods from one place to another. I mean, I haven't done the calculation, but my gut tells me that if we can get oil prices back down to where they were, at the beginning of the Biden administration, that a big chunk of the inflation number just disappears. So again, back to the Federal Reserve. The Federal Reserve is raising interest rates. Yes, it's going to make it harder for some people to afford a new home or to refinance. But it isn't the borrowed money that is the reason for inflation. So making it harder for people to borrow money, it isn't going to, in my opinion, lower the inflation rate. The second thing that the Federal Reserve is going to do is they're going to start pulling some of the money back, the quantitative easing that they started doing during the financial crisis, of 08. They're going to start pulling some of that money back. And while we agree that they should do that, it's probably going to be 3 to 4 years until they pull enough money back to actually get to the point where dollars are going to be coming out of the economy. And the reason for that is that the Federal Reserve, again, over the last 12 to 14 years, has been pumping money into the banks, and the banks just haven't needed it. So what the banks have done is they've deposited that big chunks of that money back at the Federal Reserve in the form of what's called excess reserves. And so as the Federal Reserve starts to taper uh, they're going to pull money out back from the banks. The banks don't have to stop lending. The banks will just go to the excess reserves and give that money back to the Fed. So, in my opinion, the Federal Reserve's actions are driving a lot of the market volatility that we're seeing, because a lot of these program-based traders just have rules in their algorithms, in their artificial intelligence, that say, well, it's a bad thing when the Federal Reserve starts tightening, and so let's take some actions that historically have meant that we, the institutional traders, can make money. But the Fed's actions, in my opinion, again, raising interest rates will have an impact on housing, but we're so flush with cash in the United States right now that it's not going to have a material impact on the abundance of dollars chasing the limited amount of goods and services. Really, the place that the government and that the private sector needs to be focusing on is getting things back open, because we need to increase the amount of goods and services that are available. That's what's going to bring inflation down. I don't see the government taking those actions right now. I think I just saw a news report that the Biden administration is going to look to try to make oil companies produce more oil, or not charge so much per barrel, or that's not going to solve the problem. The fundamental problem is that we need our manufacturing and our service sector, which is continuing to grow at a rapid rate, but we need to get all of the U.S. economy completely back open, completely back up to pre-pandemic levels, to get our supply chain issues addressed, and then we'll have goods outweighing dollars and inflation comes down. But again, the markets are reacting in a volatile way to what the Federal Reserve is doing and the fact that inflation is high. And so I expect to see continued volatility. We sort of see the markets, drop aggressively. And then, at least over the last several months, they sort of work their way back a little bit. And then some other, piece of news, legitimate or not, that sounds horrible, then the markets drop. There's just no telling when this volatility is going to end, but it certainly isn't, in my opinion, an indication that the market volatility is not an indication that the U.S. economy is in the ditch. To the contrary, the U.S. economy just continues to work its way out of the pandemic and continue to grow. But it's going to be hard to evidence that when people keep talking about, GDP is potentially going to be falling for 2 consecutive quarters and we're going to be in a recession. If that actually happens, it'll be the first time that I can ever remember where the U.S. economy, the private sector, was growing and we were in a recession. So a lot of information there, a lot of talking about the Fed and government spending and GDP, but it's just super important that investors understand that if you own good quality investments, sometimes when times are crazy, they go down. And if you sell, all you're doing is locking in temporary losses, and then you got to ask yourself, okay, well, when do I get back in? And I've said this 100 times, right? If you get out based upon fear, then the only thing that's going to get you back in is greed. And that's just a horrible recipe, because Murphy's Law, it's there for a reason, right? If you get out, you'll be getting out at the bottom. And if you get back in based upon, fear and greed, you're going to get back in at the top. So you've just got to rely on the math, and that's what we're doing here. I'm looking at these charts on a daily basis, not just once a day, all day long. And what the charts tell me is that outside of the government sector, the U.S. economy is continuing to dig its way out. Especially the service sector is really opening up now. So even if we go into a technical recession, that does not necessarily mean that the U.S. economy is in trouble. And that's why we're not abandoning the market right now. There will be, as interest rates rise, there will be opportunities in the fixed income sector that just haven't been available for 10, 15 years. And I'm actually looking forward to that, man. And I remember the days when you could walk into a bank and get a 5% CD, no problem. If we get to the point where I can start buying AAA government-backed bonds and I can get 4, 5, 6%, oh my gosh, that actually becomes a real part of an investment portfolio where you don't have to worry about, I bought a 1% CD and I'm locked in for 3 years. If you're getting paid 5% on a 3 to 5 year bond or a CD, I mean, that's totally worth doing as a percentage of your total portfolio. What you don't want to do is lock in, low interest rate investments in a high inflationary environment, because then you're just locking in losses. It may not feel like it, but you're locking in losses of buying power. So, a lot of information there. If anybody has any questions about any of these things, I've been getting a lot of calls the last couple of weeks and emails and direct messages, with people they're concerned, and I get it. And what you have to rely on when times get volatile is you got to focus on data. Don't focus on headlines. If you focus on the headlines, all you're going to do is take steps that you may regret later. So if you have any questions about this or any other financial matter, please send me a message, post a reply to this update, call me, reach out any way you can. I will reply to any questions from anybody who has the desire to ask them. But that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back again soon with another Uncommon Sense update. Thanks for watching.
If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.